Hello everyone. Now this lecture actually you can say that the revision of the CAPM topic. Okay, over here we will pick up three important aspects. This revision lecture where students actually get confused. So the first question where students the traditional portfolio theory versus modern portfolio theory. How we are actually and why we are moving from the traditional to the modern portfolio. Then we will discuss little bit about the efficient frontier, though we have discussed in detail previously, including the calculation that how we derive this efficient frontier. Clear? Then the most important point, that is the difference between the capital market line and the security market line. Clear? So now, first of all, give the heading traditional portfolio theory traditional portfolio theory versus MPT, that is your modern portfolio theory. Okay, now before we start with the theory, so let me ask you very simple. See, if you will invest all your money just one stock, okay, is that risky? Definitely, the answer is yes. Okay, now what if we invest in two stocks? Okay, rather than investing in one stocks, now I'm investing in the two stocks. Okay, a little less risk. So now the important question is why this is less risky. Okay, so most people will say that, sir, I have diversified my portfolio in two different assets. Now this is where the difference between the traditional and modern portfolio theory comes. Clear? So sir, what is this traditional portfolio theory? Okay, traditional theory says that don't put all your eggs in one basket. That's it. Okay, they say that you should not park all your money in just one asset. This is actually said by the traditional theory. Okay, even modern portfolio also says the same. So then what's the difference? So the difference is traditional portfolio theory just says that don't put all your eggs in one basket, but there are no formulas, no graph, no statistics. Are you clear? That's the difference. So now the next point is, sir, how investor thought traditionally. Okay, they looked at each stock separately, that this stock is risky, this stock will give me the good return. Let us buy the few stocks so that I can increase my return or reduce my risk. So they are looking at from the individual stock perspective, not from the holistic portfolio perspective. Are you clear? Like I am saying that stock A fluctuates a lot, it's risky. Stock B fluctuates a lot, it is also risky. But if you will combine both A and B in your portfolio, then it will become a risky portfolio because both are risky. Clear? So there is no mathematical proof that they will reduce the risk of your portfolio. Okay, there, because that comes in the modern portfolio theory that, sir, there is a high correlation or low correlation. If there is a low correlation, then it will reduce the risk of my portfolio. If there is a high correlation, it will increase the risk of my portfolio. All these discussions were not there in the traditional portfolio theory. At that time, they don't have that information that whether we should go with these two stocks, these three stocks, these four stocks, where the purpose is, sir, I want to increase the return of my portfolio and reduce the risk of my portfolio. Clear? So now in short, if I want to say, sir, why I don't want to use the traditional portfolio theory, there are 4 points to be discussed. Sir, number one, I don't know how many stocks are enough in my portfolio. Second, how much risk is reduced by diversification? There is no such calculation. Clear? And the third one, sir, which combination is best for me? Clear? And fourth one, there is no quantification, sir, what is the optimal portfolio? So everything is just based on judgment and experience. Clear? So they say that diversification was qualitative, not quantitative. Clear? This was the whole discussion about the traditional portfolio theory. In short, if I want to summarize, they say that diversification is good, but they are unable to quantify it. Okay, there is just a qualitative behavior, not the quantitative one. Clear? Now comes the MPT, modern portfolio theory. It came in 1952. Okay, Now, we have asked some different and a smarter question. Okay, why are we looking at stock individually when we invest in a portfolio? Okay, not the stocks. So this line have actually changed the game in the finance forever, where I am discussing, I am thinking about a portfolio where you have multiple assets, multiple stocks, multiple equity. So I have to look combined. Okay, so investors cares about the portfolio risk and return, not about the individual security. Clear? And risk can be reduced through diversification if assets are not properly correlated. So over here in this line, correlation is the hero. Correlation. If correlation is low, you can get the diversification benefit. That's why in our portfolio, I've heard that we combine stocks with the bonds with the gold. Clear? This will give me a better diversification because there is a low correlation between these assets. Clear? So traditional portfolio theory is just guessing. Okay, but modern portfolio is not guessing. They say that, okay, let's measure the risk. Let's use mathematics. Let us look at the relationship between the assets. That is your correlation. So risk we are measuring with the help of variance. Risk we are measuring with the help of variance and with the help of standard deviation, and relationship between the assets we are measuring it with the help of the standard correlation. Clear? So now the thing is very clear that stock A will go up when the economy is good, stock B will do well when the economy is bad. Clear? They both are risky. Stock A and B are risky, but if I'll keep both of them in my portfolio, then what will happen? When A will fall, B will increase, and when A will rise, B will fall. Clear? So overall portfolio will become more stable, and this is diversification with logic, not the belief. So over here we have multiple stocks. Clear? I have identified that these four stocks are best. If I'll take a combination of these four stocks, that too in the given weightage, say 10%, 30%, 40%, and 20%. Now this will make the my portfolio as an optimum portfolio. Clear? Now, traditional theory also ignored the correlation. Okay, that how the assets are relative to each other. Okay, so MPT have answered it with the help of the covariance, and with the help of correlation. That's why MPT can prove that yes, see, diversification is actually working. Are you clear? So now the first question is clear to you. Sir, what is the difference between traditional and modern portfolio theory, and how we move from traditional to the modern portfolio theory? Clear? Now coming to the next point of discussion, that is our efficient frontier. Okay, now that is actually the heart of the modern portfolio theory. See, when I'm saying that, sir, we will measure the risk and return mathematically. Clear? Now MPT will give us the efficient frontier. Okay, what is this efficient frontier? Write down. It shows the best possible return, best possible return, best possible return for a given level of risk, for a given level of risk, best possible return for the given level of risk. Or write down another statement, lowest risk for a given return, lowest risk for a given return, lowest risk for a given return. So any portfolio below this line is inefficient, any portfolio above this line cannot exist. Now try to understand this first of all. Okay, now this is your return, this is your risk. Now presume that here we have one point, this is another point, and this is another point. Clear? Now point number A, point number B, point number C. Now what I am trying to say that, sir, point number B is the most efficient portfolio because you cannot get this return at the same level of risk, because see, these two portfolios are available, A and B. Okay, let us presume that both portfolios are possible, A and B. Now A will give you the return of 8%, B will give you the return of 10% at the same level of standard deviation of say 12%. Now tell me which portfolio you personally prefer between A and B. Definitely any rational person will go for the portfolio B, because at 12% risk, I am going for the 10% return portfolio. Why will I choose 8? I'm not going to choose it. Now, one thing is clear, sir, that between A and B, I will go for the B. Clear? Now, suppose you say that, sir, what about C? What if C is available? C is available means what? That at the same level of risk, there is a portfolio available which is giving you much more higher return, say 14%. Say 14%. Now, when these information is available in the market, then what will happen? Everyone will jump into that portfolio. Everyone will jump into that portfolio. Everyone will go for the particular portfolio. The demand for that portfolio will increase, or you can say the demand for that asset increase. What will happen? Gradually the price will increase, and when the price will increase, then the return expected from that portfolio will decrease. Try to understand this. Sir, there is an asset currently priced at 100. Clear? And that particular asset can be sold at 10110. This is giving me an optimum return of 10%. Clear? But suppose there is one more portfolio available at 90. Okay, having the same risk of 12%. Okay, the price of the portfolio, the price of the asset is 90, and it again at the end of the 1 year will fetch me 110 rupees. That means I am making 20 rupees in the form of profits, approximately 22% return. Everyone will start buying this portfolio when the price will increase, when there is a huge demand. So gradually you will see that immediately the price will start increasing, and it will come at 100. Because if there is some mispricing, or if there is some opportunity available in the market, what we'll do, we'll try to capture that opportunity. That leads to the increase in the price from 90 to 100, and it will priced at 100, that it to its normal pricing level, and now your return is 10%. So any points which exist below the efficient frontier, sir, I'm not going to choose. Any point which exists above the efficient frontier will not exist, because as soon as if someone will find that yes, that at the same level of risk you are getting higher return, everyone will jump into it. They will take the arbitrage opportunity, make the price come back to its normal level. Are you clear with this? Again, so what efficient frontier actually inform us? That sir, this is the best possible return. When they are saying this is the best possible return at the given level of risk, that means there cannot be multiple best. Best can only be one. So this point B is the best point. Clear? You will not go below that. You will not go above that. Clear? So now finally, when I'm closing it, one thing I can say that the investors care about the portfolio risk and return, not the individual security. And risk can be diversified away when you will invest in multiple assets which are not perfectly correlated. Clear? So what are the key characteristics of a modern portfolio theory? If you want to write it down, write down. Number one, that focus on portfolio as a whole. Point number one, focus on portfolio as a whole. The second point, use statistics and mathematics. Use statistics and mathematics. Explicitly consider correlation and covariance. Explicitly consider correlation and covariance. And the fifth point is, it seek for the optimal portfolio. That which portfolio is best. Optimal portfolio. Clear? Now, in the modern portfolio theory, key concepts have been introduced. One is your efficient frontier. This is the first point. Clear? Then we will study about the risk and return trade-off. Means if you will increase your risk, the return can also increase. Expected return can also increase. Introduction of covariance and correlation. Systematic and unsystematic risk. Systematic risk which is coming from the market, unsystematic risk which is individual stock specific, and the last one is optimal portfolio selection. Optimal portfolio selection. So all these actually came into existence after we have introduced the modern portfolio theory. Clear? Now, these theory have some assumptions. Assumptions number one is investors are risk averse. They are afraid of taking the risk, and if they will take the risk, they need the premium for that. They also presume that market are efficient. Efficient means there is no mispricing in the markets. Returns are normally distributed. Returns are normally distributed, and investors care about the mean and variance. Investor care about the mean and variance. Clear? So this is the whole understanding. So now I'll plot a difference between the traditional portfolio theory and model portfolio theory. Traditional portfolio theory and modern portfolio theory. So the focus of traditional portfolio theory will be purely on the individual stocks. Clear? But the modern portfolio theory focus is on entire portfolio. Clear? Risk definition, it focuses only and only on standalone risk. Okay, what is the risk from my given asset? It focuses on the portfolio variance, that what is the risk of my portfolio. Diversification over here is just qualitative in nature. Okay, but over here you can quantify it. Clear? Correlation not considered in TPT, but it is considered in modern portfolio theory. No mathematical models, we have mathematical models. Optimal portfolio is not defined in traditional portfolio theory, but it is defined in the modern portfolio theory with the help of efficient frontier. Clear? Risk reduction is limited because you are just using the qualitative approach. Clear? But over here it is scientifically proven. Clear? So this is the difference between your traditional as well as modern portfolio theory, and these modern portfolio theory then have given rise to these index funds, clear, mutual funds, asset allocation models, asset allocation models, clear, passive investing, passive investing. You will study all these things in detail when you will move ahead from book 3 and book 4. Okay, now the only point which is left for me to discuss in this lecture is the difference between the security market line and the capital market. Clear? Now give the heading for CML and SML. ML and SML. Now students get confused over here a lot. We'll start with the basic understanding. Sir, CML, why? How it actually helps us? Okay, for that, write down one question. It actually answers one question. Okay, write down that question. What is the best return? What is the best return? What is the best return for a given total risk? For a given total risk. This is the question which is actually answered by the CML. Now you see over here two important factors. The total risk. I am considering the total risk, systematic plus unsystematic. That means I am going to say that we have considered the sigma over here. Clear? And the second point is the best return. Best return means it will include all possible investment which will give you the best return. And when you are investing, when you are looking at from the investor's perspective, you can invest your money in the RF as well. That means if suppose you don't like risk, so what you will do, you will simply invest in those assets which are purely risk free. If I wish to, I can invest. So this is from the investor's perspective. If investor is asking me, sir, what is the best return for the given total risk? If I want to take, suppose I want to take 0% of the risk, then what is the best possible return for me? I'll say 3%. I'll invest in the government security bond. I'll earn 3%. But suppose if I want to increase my risk to 1%, my return will increase to 5% gradually. Suppose I want 5% risk, you will say, sir, you will get 14% return. Clear? So you will see that the diagram of capital market line is something like this, where you will get 3% over here at 0% risk, and when you will move ahead for 1%, you will see that your return increased to 5%, and when your risk have increased to 5%, your return have increased to 14%. So this is a capital market line which justifies the fact that higher the risk, higher the return. So this is the question which is answered by the capital market line. Clear? So write down, once you have written this question, and after question, make sure that in your notes you will write down these graphs. These are your risk, these are your returns. Okay, now write down the CML, the capital market line, shows the best possible risk return combination, available to investors when three conditions are satisfied. First one is risk-free asset exist in the market. Risk-free assets exist in the market, and yes, they are available. Okay, then investors can borrow or lend the money at RF. Investors can borrow or lend the money at RF. Clear? Investor will hold the efficient portfolio. Investor will hold the efficient portfolio. So now you're asking me, sir, please tell me, if I will be investing in a market, okay, where risk-free assets are possible, where I can borrow or lend the money at RF, then what is my expected return? So now when I am writing your expected return of the portfolio, the first thing is that, sir, minimum I am going to get RF. That is for sure. Clear? Sir, I am going to get RF. Okay. Sir, above RF, if I am going to take the risk, above RF, if I am going to take the risk, I am going to get the market risk premium. How you will get the market risk premium? You remember CAPM, RM minus RF, This is your risk premium. So if you are investing in a risky portfolio, you will get the risk premium. Now that risk premium will be amplified with the beta in the CAPM, but beta only captures the systematic risk. Over here we are capturing the total risk. So I will multiply this with the sigma of my portfolio, and divide it by sigma of the market. Now I will get the expected return of my portfolio from the investor's perspective. Clear? So over here, this sigma p, this denotes the total risk, or you can say the standard deviation, and this is the expected return on the market portfolio. Clear? Are you clear with this? Now I said that I want my portfolio to be efficient. Efficient means what? I need to take the help of the efficient frontier curve which is available. I need to take the help of the efficient frontier curve which is available. I'll draw the efficient frontier curve. Okay, so this is the efficient frontier curve which is available in the market. Now I will draw a tangent to this. I'll draw the tangent to this. Now this is your market portfolio. This is my market portfolio. Clear? You can denote it like this. This is my market portfolio. Clear? And this is your capital market line for that investor. Okay, you have drawn this capital market line for the investor. Now you have combined the line with the efficient frontier, and then you got the market portfolio. First you have drawn that capital market line, okay, and then you have matched it with the efficient frontier to get this tangent, and this tangent is nothing but the market portfolio. Clear? So if suppose someone wants to draw this capital market line, So what is the step-by-step process? So first I'll draw the efficient frontier. Then I will decide a risk-free asset line. Clear? Where is my risk-free asset? Then from that asset, I'll draw one tangent towards the efficient frontier. Clear? Are you clear? And this tangency point will be denoted as market portfolio, or you can say it as M. And this tangent line is known as capital market line. Clear? Now the question is, sir, why this CML exists? Write down. Why this CML exists? The first one, investor want maximum return for total risk. Investor want total investor want maximum return for total risk, for total risk. Clear? Second, risk free asset will improve my diversification. I want to diversify my portfolio. Clear? So in my portfolio, I want to put some of my money in the RF as well. I want to stay safe. Clear? Third is rational investors. Okay, we have seen an example of the rational investor. Like I am a rational investor. Clear what I have done? I have some of my money invested in the FD, which are very safe. Clear? Then I have invested some of my money in the market portfolio. That means your Nifty, Sensex, something like that. I have invested some of my money in the commodity, that is gold and silver. So this leads to one optimum risky portfolio for all investors. Now this is the optimal risky portfolio available in the market for all investors. Are you clear? So again, if I am repeating the key properties of CML, sir, it applies to efficient portfolio. Risk is measured with the help of standard deviation, and the slope of this is nothing but the Sharpe ratio. Slope of this is nothing but the Sharpe ratio. So can you define the Sharpe ratio over here? Yes. If I can rewrite this formula like this, RF plus RM minus RF divided by sigma of the market multiply with the sigma of the portfolio. So what is this? This is nothing but the slope of the line. Okay, mathematical term, slope of the line, but this is a Sharpe ratio formula. Sharpe ratio. What is the meaning of Sharpe ratio? Sir, per unit of risk, how much extra return I am getting? Per unit of risk, how much extra return I am getting? Clear? Are you clear with this? And it dominates the efficient frontier. So now I have given you a brief understanding of what is capital market line. Okay, now I'll start with the security market line, and then later on I'll combine both of them to help you to differentiate between these two lines. Clear? Now give the heading SML. That is your security market line. Now security market line, how it is going to help you? Okay, write down the question. What is the required return? What is the required return? What is the required return for a given systematic risk? For a given systematic risk. You remember capital market line? Best return versus total return. Clear? Systematic risk, CML, total risk. Now the investor is asking, sir, suppose, presume that in my portfolio it is purely having systematic risk. Okay, I have diversified my portfolio as per the rule of CAPM. Clear? As per the rule of CAPM, my portfolio is completely diversified. There is no idiosyncratic risk. That means there is no risk which is a stock specific. Clear? Sir, in that situation, what is my required return? That is explained by SML. What is the required return for a given systematic risk. Now, given systematic risk means, sir, 4%, 5%, 6%, 7%. Sir, in these situations, what will be my required return? How much return I should go for? How much return I should expect if suppose 7% is the systematic risk, and systematic risk is denoted by beta, that is your market risk. Total risk is denoted by your sigma. So the holistic view is clear. The difference between the capital market line, the difference between the security market line. Are you clear? Okay. Now moving ahead, write down. Security market line is actually giving you the relationship between the required return, or you can say expected return. Expected return and the systematic risk, that is the beta. So, sir, SML is showing the relationship between the expected return and the systematic risk, that is beta. Now, SML can be applied to individual securities. Sir, it can be applied to inefficient portfolio. Sir, it can be applied to inefficient portfolio. And sir, this can also be applied to efficient portfolio. You can use SML, individual securities, inefficient portfolio, as well as efficient portfolio. Clear? Now you remember the formula of CAPM. CAPM formula, RF plus RM minus RF, multiply it with the beta. Clear? And this will give you the expected return, whether on the asset or whether on the portfolio. Clear? Now, so the question is, sir, how this SML is derived? So how this SML came into the picture? Okay, see, assume that investor will hold the market portfolio. Clear? Market portfolio, which is purely diversified. Clear? That means what? There is only systematic risk. We don't have any unsystematic risk. So unsystematic risk is purely diversified away. Now your required return increases linearly with the beta. If beta is increasing, your return is also increasing. Earlier with sigma, your portfolio return is increasing, but now my return is increasing proportionate to the beta. Clear? So why this, sir, SML actually exists? See, investors are not rewarded for diversifiable risk. Clear? Only market risk is something which matters. So asset price will adjust until the expected return matches the risk. Clear? So they are saying that asset price will match the market risk, not the individual stock specific risk. Clear? So the key properties, if I'll jot down the key properties of SML, sir, it applies to all the assets. Clear? It can even apply to the portfolio. The risk is measured with the help of the beta, and over here the slope is RM minus RF, that is market risk premium is the slope. And what is the intercept? The intercept is the RF, because we are starting it from RF only. This is the RF, this is the intercept. Clear? This is the intercept. And what is the slope? Slope is RM minus RF. Clear? Are you clear? So now I have given you a brief understanding of, sir, what is CML versus what is SML. Okay, now CML and SML. If I want to measure the risk of my portfolio, clear? Risk. CML measure is with the help of the total risk, that is your standard deviation. SML measures it with the help of the systematic risk. Now this applies only and only to efficient portfolios. It applies to all assets and all portfolios. Clear? It comes from the modern portfolio theory, and this comes from the CAPM. Clear? Now the slope over here is Sharpe ratio, and over here is the risk premium. Clear? Intercept is RF in both the cases. Clear? Shape is straight line for both of them, and the purpose is, sir, I want to choose the portfolio. In CML, I want to choose the portfolio, and SML is used for asset pricing. Sir, what should be the price of the asset? That will be defined based on the expected risk and expected return of that particular asset. Means if this particular asset is giving me 10% return and 14% risk, what should be the price of that asset? Similarly, if this asset is giving me 14% return and 28% risk, what should be the price of that asset? So SML is used for asset pricing, CML is used for portfolio selection. Are you clear? Now let us discuss few of the points, like sir, why CML is using sigma and why SML is using beta. See, CML is a portfolio we are creating where we can invest. So there is a possibility that, sir, my portfolio is not fully diversified. That means what? Total risk matters. Okay. Then I will capture both systematic risk as well as unsystematic risk. But over here, the assumption starts with the fact that my portfolio is completely diversified, unsystematic risk is zero, and only I have is systematic risk, which is measured with the help of the beta. Are you clear? So sir, if I want to choose the portfolio, I will consider the CML. If I want to value an asset, I will use the SML. Clear? So finally, before I close this session, again a few repetition between the CML and SML. Sir, how should I combine the asset? Answer is CML. Sir, is the asset fairly priced? You will get the answer with the help of the SML. Clear? Or if I'll give you a better relatable example with respect to car. Suppose there is one statement, sir, what is the maximum speed this car can achieve for given engine size? Okay, the moment I'll increase the engine size, maximum speed will increase. Sir, answer is CML. Is this car overpriced or underpriced given its engine power? Answer with the help of the SML. You have the same car but two different questions answered by two different methods. Are you clear? Now what we'll do, we will do a small exercise to understand that how we will do the asset pricing with the help of the SML. Okay, so we can calculate the expected return of the asset with the help of that CAPM formula, RF plus RM minus RF multiplied with the beta of that particular asset. Clear? Now suppose you have the value of RF. It is given to you at 5%. Market return, it is given to you as 13%, and stock beta, it is given to you as 1.2. Now with these information, can I calculate the expected return? Yes, 5 plus 13 minus 5 multiplied with 1.2. So the answer is 14.6%. 14.6% I demand as an investor. At least I want 14.6% return from that particular asset even its beta is 1.2. Clear? Now I demand. Clear? Now there is a comparison chart. Comparison chart between the expected return and the required return. Clear? Now as per the given asset, okay, there is a given asset, my required return is 14.6. Clear? And suppose the expected return from the asset is 17%. This is my requirement, this is the return from the asset. What I'll say, sir, it is undervalued because it is giving me more return than my requirement. Sir, it is undervalued, I should go for it. Okay, it's not fairly priced. 14.6 is the expected return, 14.6 is the required return. Sir, it's fairly priced. So this is fairly priced. Okay, suppose it is 12%. Expected return is 12%, but I want 14.6. Sir, it is overvalued, overpriced. When it is overpriced, why? Because its expected return is lower. Price is higher, that's why its expected return is lower. And that's why this is overpriced. So can you see that how I have used SML to understand that whether a particular stock is fairly priced, underpriced or overpriced. Clear? So now if suppose I will draw the SML line over here. Okay, this is my SML line. Now if my asset is actually lying on the SML, that means it is fairly priced. If it is below the SML, that means it is overvalued. This is overvalued. Clear? And above the SML, that means it is undervalued. This is undervalued. Are you clear? Now, similarly, we can solve one numerical for the capital market line as well. Suppose the RF is given to you as 4%, expected return of the market is given to you as 12%, standard deviation of the market is given to you as 20%, and the standard deviation of the portfolio. Okay, suppose investor want 10% standard deviation of the portfolio. Then in this situation, what should be the return he is expecting? Okay, what should be the expected return? Clear? So how to calculate? Sir, RF plus RM minus RF, that means 12 minus 4 divided by sigma of the portfolio, that means 20%, and multiply it with the standard deviation of your portfolio. This is the standard deviation of the market, this is the standard deviation of the portfolio. Now with this, I will calculate the expected return of the portfolio, which is coming as 8%. Now write down, this is the maximum possible return. This is the maximum possible return for 10% of total risk. 8% is the maximum possible return for 10% total risk. That means if I am taking 10% total risk, the maximum return I can get is 8%. Clear? So now if there is any line, any point lying above the capital market line, now imagine that suppose this is a capital market line. Okay, now suppose this is the point, okay, where you have invested, but suppose there is a portfolio which is giving you more return, okay, at the same level of risk. Suppose this portfolio is giving you 9% return at the same level of 10% risk. Clear? Then everyone would invest in this, price will change, returns will fall back to normal, that is 8% return. So it will move back to the capital market line. Here, so in this lecture, I have discussed how we move from traditional to modern portfolio theory. We have discussed the efficient frontier. The calculation of efficient frontier I have already discussed in the previous sessions. Then we have discussed about the two confusing lines, that is the security market line and the capital market line in detail with example. Okay, thank you. I'm ending this lecture here. Hopefully this will help you.